My name is Kirk Reagan, and I'm here today to talk about deploying. So, unfortunately, if you got that news that you're about to deploy, well, I've got some way to make lemonade out of lemons. So today I'm here to talk about what the benefits from a financial perspective are of deploying. All right, so obviously the big one is Combat Zone Tax Exemption. So most of you probably already know this, but any income earned while being in a combat zone is tax deductible. This is all pays. So this is your base pay, maybe even any flight pay or any hazardous duty pay or anything like that. That's all going to be tax exempt, at least for those under the ranks of 05 and below. And some of you may even be eligible to get your bonuses at a tax-free rate in that. It doesn't apply to all bonuses, specifically in the officer side, but if you are due a bonus, check into that. Your bonus may be eligible for tax exemption. The other one is your imminent danger hostile fire pay. So for the privilege of getting shot at or maybe getting shot at, you're going to pocket an extra $225. So not a lot, but it's something extra. The other one is family separation pay. So all that time that you're going to be separated from your family, they are going to reimburse you that at $250 a month. The other one is a savings deposit program. This one isn't as well known, and it's something that you have to set up in theater. But if you have $10,000 in cash against, let's say, an emergency savings account or in a high yield savings account, go ahead and take advantage of this option. So this is if you put $10,000 into the savings deposit program, it will earn a guaranteed 10% return while you're deployed. So a good one to take advantage of. The other one is accrual of tax-free leave. So when you get back, even some of those follow-on days may still be tax exempt, because when you get back, likely you're going to be taking some leave, and that month may not be tax-free. Just be careful about that, because it is first in, first out. So if you return on, let's say, the 4th of the month, well, you've probably already got at least one of the day in that month as tax-free. So you would be entitled to get that entire month tax-free. Now, if you go home and immediately go on convalescent leave or something like that, you're going to have those leave days be taken at the same time that you already have that tax-free status. So that's something that you may or may not be able to play with, but if maybe you get home at the end of the month, maybe that's something that you consider of seeing if your boss would let you work a couple extra days to get you into the next month, and then have those days be fresh in a new month as tax exempt days. The other one, we used to call this another day, another $3, but that was in my day. Today it's $7. So any incidentals, you're going to get paid $7 a day, whether you use it or not. All right. The big one here is your thrift savings plan. So depending on how you have it set up, if you have traditional contributions, what's going to happen is those contributions are going to go into that account, and they are going to be tax-free contributions. So when they come out, they are going to be tax-free. You won't have to pay tax on them like you do out of other tax-deferred accounts. But the earnings on those are going to be taxable. Now, in a Roth account, when you put it in, that's not going to be taxed because you're in a combat tax exempt status. And then when you get the earnings and contributions out, they're all going to be tax-free. So make sure you're putting those contributions, if you are doing a traditional, make sure you're switching those over to Roth when you're deployed. It is a big money saver there in the end. And then for those of you that have boatloads of money that you want to stash away into these Roth accounts, well, here's your chance, because normally you're limited to that $23,000 or maybe an extra $7,500 if you're over the age of 50. That's going to be your limit. But when you're in a combat zone, you are allowed to contribute to the absolute maximum of the limit, not just the individual contribution limit, but the overall 401k limit, which for 2025 is going to be $69,000 if you're under 50. And if you're 50 years of age in that calendar year, it's going to be $76,500. So a great opportunity to stuff a whole lot of cash into your Roth. So if you're trying to put in more money into your Roth, but you're limited to that $23,000 and you've got a whole bunch in your taxable account that you want to get into your Roth, now's your opportunity. All right, here's another one that not a lot of people know about, but it's the Savers Credit. Normally, most folks that are like E5 and above won't qualify for the Savers Credit. What it is it's on the first $2,000 per person. So if you're married, it's up to $4,000, and it's either 50% of your contribution. So if you contribute $4,000, they would give you a tax credit of $2,000. That's in the lowest income bracket. And then it goes down to 20% and 10%. And so here I have the breakouts of what those different income levels would be for single and married filing jointly, and then kind of what those maximum credits would be. The other big opportunity is going to be capital gains. If you have a taxable account that you bought Apple stock 10 years ago and it's got a huge gain sitting in it and you want to sell it, but you don't necessarily want to sell it right now because you don't want to take the capital gain, or if you weren't planning on selling it, but you want to accept that capital gain, there's no limit. Like, you can sell it and then buy it back the next day because you're not taking a loss. You're actually taking a gain. So there's nothing, the wash rules don't apply here. So you can take the capital gain and then buy it right back. So go ahead and take advantage of that. If you've got a capital gain sitting in an account and you're going to be in the capital gains 0% bracket, let's go ahead and harvest those gains. All right, income brackets. So if you're deployed for, let's say, 6 months, you're only going to have half of your normal income. Now, this depends on your spousal income because that is all still going to count. But if you're a single person or if you're married and your spouse doesn't work and it all depends on your income, you could be looking at half of your income in a given year going away because it's going to be tax exempt. So this is going to lower you in those brackets, especially when you still have the capability of taking that full standard deduction. So now you're going to be taking half your pay, but the full standard deduction, and that's going to lower those income brackets. And you are probably going to get into the 10 and 12%, and you're going to have more room and space in those brackets. So what can we do with that space? Well, if your spouse was thinking about going a job, but hey, maybe it wasn't really worth it when you looked at how much of the taxes were going to be taken out, or you just weren't able to do it, well, maybe now's that opportunity. The spousal income might be able to fit in those lower tax brackets. The other thing is, if your bonus wasn't eligible in the tax exempt status, well, that bonus can now fit in. So if you got a very large one-time bonus, maybe it's a one-time upfront bonus, maybe it's your year to go on a deployment so that would stack on top of that bonus, bringing the income level down and being able to fit more of that bonus into those lower tax brackets. The other thing is, if you have an outside account like a traditional IRA, or maybe your spouse has a 401k that got rolled over into a rollover IRA, or maybe they even had the ability to do Roth conversions inside of their plan. Now, you're not able to do this in a TSP, but in an outside, maybe a spousal one, you might be able to do this. So think about that, is you can do those Roth conversions, and those Roth conversions might take place in those lower tax brackets. The other thing to consider is lumping charitable donations. If you're a charitable minded person and you typically give, let's say, every week at church or something like that, maybe it's time to put more of that money in a year where you're not deployed. So maybe we load up and take all of that and we put it in December when we know we're going to deploy in January. We load that up in what's called a donor advised fund. If you want to look that up, plenty of companies offer that. And if you put it in the donor advised fund, it all counts as a contribution in that year, but you can space out when it actually goes out. So you could have it write a check out to your church every week, even while you're deployed, but you get to take that deduction in the year prior. So that's something to consider. So here we go. Here's the summary. So if we're looking at these ones, what I did is I did a chart here of kind of 3 different pay bands in each of the enlisted and the officer. I didn't want to go through all of them, but what I looked at is kind of what the average time in service that person might have, then the monthly salary, and then I annualized it. And then I looked at what 50% of that would be, because now let's just assume that 50% is going to be tax-free. And then I looked at the single standard deduction, and then on the bottom one, I looked at the married standard deduction, and then looked at what the taxable income would be out of that. And then I looked at, okay, now what brackets is this going to allow them to take advantage of? So across the top, I have them listed kind of from left to right on what the most advantageous things to take advantage of are. So the first one is that savers credit. That can save up to 50% of your contribution. So that's definitely one that you want to take advantage of if you can. And if you look at it in the single side, almost everybody can take advantage of it with the exception of the O5s. The O5s are still going to be above that limit, but even the O3s are still going to be able to take advantage of some of that. And if you're married, all 6 of those individuals are going to be able to take advantage of that 50% savers credit. So make sure you're loading it up. If you're single, that you're putting all 2,000 in there. And if you're married, you're putting at least 4,000. It can be 2,000 in yours and 2,000 in your wife's for the spousal in order to take advantage of it. But you do have to have it in both names. If you put all 4,000 in your name, they're only going to look at 2,000. So you need to have 2,000 in yours and 2,000 in your spouse's. Now, the next one to think about is the long-term capital gains bracket I talked about. And again, if you're the single person, all but that O5 is going to be able to take advantage of that 0% capital gains brackets, and all of the married personnel are going to be able to take advantage of that. And now I'm looking at the tax income bracket. So how much more money can we stuff and still stay within the 10% and then the 12% tax brackets? And so if you look at these, we're going to be able to get a substantial amount of money into these brackets before anything happens where you're paying into those higher accounts. So this is is an opportunity to take advantage of. So I hope you learned a lot today, and thank you for your service and thank you for deploying. We really appreciate it. And hopefully this will make your finances just a little bit easier while you're sitting in that DFAC eating the same meal over and over again. Again, thank you for your service and thank you for your time. If you like this video, please give it a thumbs up. If you like this video and you want to watch more videos like it, go ahead and subscribe. And if you've got any comments or any questions, go ahead and throw them down in the comments below and I'll be happy to answer. Thanks for listening.
Information provided in this video is for educational and informational purposes only and does not constitute financial, investment, tax, or legal advice. I am not your financial advisor, and you should consult with a qualified professional before making any financial decisions. All investments involve risks, including the potential loss of principal. Past performance is not indicative of future results. This video does not endorse any specific investment or strategy. By watching this video, you agree that I am not responsible for any financial outcomes based on the information provided.